Okay, everybody. Now let's go to section 2 of the 3 trades. Remember, we started off with the 1 minute gold line. Now we're going to talk about the 5 minute red line. The 5 minute red line, in my world, is a directional trade. The market has a tendency to hold price to the side of the market that it settles. Notice I said it settles in relationship to the red line. So, for example, if after the market opens and it does its crazy stuff and we get past news and the sentiment for the day is somewhat determined, or I shouldn't say somewhat, is basically determined, then price picks a direction normally. So if it tends, let's just say for conversational purposes, let's say it picks long for the day, or it seems that way. It starts running long at 10 o'clock, something like that. Then what I then do is with the red line is I start focusing on one of two trade setups for the 5 minute red line after we get past 10:30, that kind of time frame. And one is I call it a continuation trade. It's very, very similar to the 1 minute gold line. Okay. I mean, and I'm going to, a couple caveats to it, but it's very similar to the 1 minute gold line. It tends to not happen very often. It doesn't happen as often as the 1 minute gold line. Okay. But it's like the 1 minute gold line. And the second is a crossover retest in the direction of the market. That's the second trade. So let's talk about them one at a time. With the continuation trade, so again, let's talk about this as if we're going long. That trade, and it's a beautiful trade when it sets up. Doesn't set up often. I don't sit here and stare for it, okay? But when it does, man, it really works like butter, and it'll make you some really good money. But what it is is basically it's a Donchian channel high or a Donchian channel low. After 10 o'clock, okay, and then there's a pullback. So first step is Donchian channel high or Donchian channel low. We talked about the Donchian channel, right? Okay. Matter of fact, I think I took this trade in gold last week. I think that was the $950 trade I made. I think this was actually the $950 trade. As a matter of fact, this is the $950 trade I took in gold last week. This trade, this first one. So you have a Donchian channel high, Donchian channel low. Okay. And then you have a relatively smooth pullback. Now that's open for discussion, but I'll get to that in a minute. That's the second thing. You got to have a relatively smooth pullback. It doesn't have the same restrictive rules, and the reason as the 1 minute gold line. The reason it's not as restrictive is two things. Number one is this trade is not a bam bam trade. Okay, it doesn't just go zing zing like the 1 minute gold line. Instead, that 5 minute red line is usually pretty far away from that Donchian channel. Okay, so when that Donchian channel is pierced and then it starts coming back, there's a long way to travel. Like for example, that gold trade I'm talking about, it was at least, based on what I'm talking about, at least 100 ticks, at least 100 ticks from that to the red line for me to make 95 going back to the target that I had. So there's going to be some play in there, and it's got to run through some things. Like, for example, on that pullback, it's got to run through the 1 minute goal line. Okay. Now, granted, as long as you're after, way after, like, say 10:30, whatnot, you're not worried about that 1 minute goal line. You may not have even had a retest to even worry about it. But it's going to run its way back, and then it's just got a long ways to go. So it's going to go through some Fibonacci stuff and things like that. But you'll notice that it's finding its way to that red line. It's seeking support, and that support for the rejection, if we're fortunate, will be our 5 minute red line. Okay. So the last part is break of the candle that pierces the 5 minute red line. Now again, the entry type is exactly the same as the 1 minute gold line. So when you have candles that are piercing that red line and then close, you're going to be looking for, like, say on the long, once that candle closes, you're going to be looking to put your entry one tick above the candle that closed that's sitting on that red line. If the next candle opens and closes and it's a little bit lower, the high, for example, then you're going to be taking, and once it closes meaning, the minute's over, you're going to be taking that order and moving it to that one. And you're going to continue to do that the same way you do on a 1 minute gold line. And what's going to kill it, which I didn't even write in here, but I will now, is open / close candle and all below / above direction of trade kills trade. So what I mean is, again, red line's going up and then a candle opens and closes, body and all, below that red line that we're looking for a long. If it opens and closes below that red line, no trade. Just like the 1 minute gold line. You've got to have it. You got to have price come in, sit on that red line like it's catching it, and then it's got to push it back up away from that red line. If it goes below that red line in body and all, wick and all, then it didn't catch it. Now that's going to keep dropping and seeking some new support. And our support is not going to work. Okay? So that is the continuation trade. So the hard part in that trade is, what is a relatively smooth pullback? A relatively smooth pullback is see, this is what's hard about the 5 minute red line. A relatively smooth pullback is when you're looking at price, does it, even though there's some, like, say the candles will be mostly red, let's just say, if you're doing a long, they're going to be mostly red leading to your 5 minute red line because they're pulling back to that 5 minute red line. But there's going to be some green candles in there. There's going to be some rotations. It's going to hit the 1 minute gold line and kind of hang out a little bit. But what you have to see, because remember, this is a 5 minute candle. A 5 minute moving average. The 5 minute red line is a 5 minute moving average. Okay, if I didn't explain that enough, I'm going to explain that right now. So you got to remember, the 5 minute red line is a 5 minute moving average. It is a 21 SMA sitting on 5 minute charts. Okay, so the whole purpose of this line is it's where the bigger money trades. But we don't want to trade that specifically the same way as the bigger money, because it also means you have much bigger candles. You got bigger stop losses. When you're entering the break of that candle, you're way further away from the red line. You're just taking a lot more risk. We're not trading with all that risk and all that money like the big money traders. So we're trying to hone in at a smaller segment of that bigger price action movement. so when price is coming back from the top to our red line, okay, to a 5-minute trader, it can meander up and down because they don't see that. When the candle gets printed, it just still looks like a red candle. It can be a red candle with, whereas on our chart with 1-minute candles, it can be like this. Well, what is that? There's 5 1-minute candles. Even though we went from here to here and then down to here, to a 5-minute trader, it just looks like one big red candle. Get what I'm saying? So to them, it's still smooth. It's still a smooth pullback. So it has to look, so to us, using a 1-minute candle, it has to look deliberate, even though it's not necessarily in a straight line. Because I'm trading a 5-minute moving average with a 1-minute candle. That's the major difference between a 1-minute gold line, which is a 1-minute candle on a 1-minute moving average, than a 1-minute candle on a 5-minute moving average. Okay? So that's why the pullback has to look deliberate, but it doesn't have to be straight. Here. On that pullback, so here's your Donchian high right here, okay? On that pullback, if the candles come down and come down and come down and come down, okay, and our line's way down here. You can remember the 5-minute red line is pretty far away. But then all of a sudden price starts going up and going up and going up, and it doesn't quite go through here. And then it starts coming back down, and then it starts coming back down, and then it starts coming back down. But then it starts going back up, and then ultimately it gets here just because the event happened. Because let me explain something that you need to understand. Just because the event happened, that we had a Donchian high, and then we touched the red line, doesn't mean we have a trade. Because to the 5-minute traders, they're seeing candles that don't make any sense themselves. Because they went down and then up and then down and then up and then down, and it finally went to that 5-minute red line. That's not deliberate. How do I explain this? That's not deliberate to them either. So if it's not deliberate to them, then we don't want to be jumping in because we're counting on them to take it from we're counting on them to take it from here to here. Not us. We don't have the money to do that, but they do. Okay? So we're counting on them to move it from there to there. So for them to partake from there to there, it has to be relative. You can have humps in it, but they have to be relatively smooth to get there. It's got to be relatively deliberate. Okay? The more deliberate, the better off you are, because that means the more deliberate that move is from there to there, the more likely they're going to reverse it from there to there, because they see that they've been cleaning out the stops, and this is our support right here. Okay? The other thing you got to remember, moving averages, this right here, your 5-minute moving averages, just in case you didn't know this, which is why price has to be going north and south, and not just candles have to touch lines, moving averages, just in case you didn't know this, if price stays here in this area, right up here, and your moving averages down here, do you know what's going to happen over time? This by accident is going to come up here. That's what a moving average is. price is going to continue to average itself to the average of so many candles going back. If price stays here, that average is going to come here by default. You don't want the moving average to come to price. You want price to go to the moving average. That's where you get the reaction. I hope I make sense there. That's exactly why I talk about violence in the moves. You want, like with the 1 minute gold line, you want price to be violent to the long side and then violent on those pullbacks. You want violence because it needs to be deliberate. And it's price going to the moving average. It's not the moving average going to price. Because when price goes to the moving average, it's being manipulated by the traders that we're counting on to take it from here back to there. We're counting on them to do it because we can't do it. We're just trying to go along for the ride. Okay? So, continuation trade. Relatively deliberate. I'll try to find some examples. I think I took a gold trade last week. That was it. I think that was it. I know it was a red line trade, so that must have been it. Anyway, so that's type 1. Type 2 is trade type 2 is a crossover retest. This one has 2 caveats to it. Okay. I call it the midday aspect to it, and then the late day aspect to it. Okay. So there's 2 aspects to this. And let me kind of explain that. So like after 10 o'clock, predominantly after 10:30 to say 2 o'clock, 1:30 at the earliest, I would say, but 2 o'clock. This is equity markets. I'm talking equity markets. I'm talking NQ, RTY, those markets. Okay. What you'll have on a good market day where the market's moving, you'll have situations where price does kind of like what I was talking about on failures over here. Price will kind of meander its way to that red line. Okay. And when it meanders that way to its red line, it'll go through it. All right. It'll go through the red line. So let's say the market's up again. Okay. Let's say the market's up again. And, and that moving average is going up and price is up, and then price starts coming down, and it's just kind of meandering. So, again, that's why you got to be kind of after 10:30, when price starts to meander. What you'll find is a lot of times it's somewhat similar to the 1 minute gold line. Price will just kind of meander its way through the 5 minute red line. So now it's below it, but the market's up. Okay, so we're up, say, a couple hundred points, whatever. The market's been trending up since, like, say, 10. It's the simplest way for me is to just pick one side of the market for now. Everything I'm saying is again, reverse to the downside. So the market's up, price is up, and then you get 10:30, whatever, price meanders its way down, and then price actually settles itself through the 5 minute red line underneath it. Okay. So what I like to discuss with this is okay, price is seeking some place of support. Again, could be a Fibonacci, could be, way over to the left, a major pivot that got broken, 6 months ago. I don't know. It's seeking something. Price is seeking something. All right. But where we can make money, you and me, is stay out of all this noise, because we don't know what level it's seeking for support. Okay, that's this trade here, the crossover retest. But we know one thing, the market's up. Okay, that's what we know. We know the market's up. So the buyers hopefully will be looking for another reason to continue to add to the up market. Okay, the only thing I know how to look for to do that is a scenario where the market finds some kind of bottom to it, okay, and it comes back up into the bottom of the red line, but then it now remember that red line still leaning up, most likely. Okay, it's running on a 105 candle thing, so it's still bulk. If 15 candles even are below that red line, then that means there's still 90 candles that were north of that red line that are still in that average, still holding it, up. So what we're looking for is we're looking for that candle, those candles, to run back through that red line. And what happens so often when we have an up day and or a down day and price runs itself back through that red line in the direction of the existing market trend, long or short, is it will create space. So here's your red line, okay? And your candles are down here after already being, up here all morning, okay? And then it'll start thrusting itself back up because it found its bottom. We don't want to guess where that bottom is. Okay? You and I don't want to guess. Okay? We don't have that kind of money to guess. We want to be exact as to why we're doing something. So what we're looking for is this. We're looking for price to come back up. And so many times this happens. And then get this out of here. All right. So what did we just do? We just created that, whatever that bottom was that it was seeking, a Fibonacci, whatever, we're looking for it to boost it out of the current downtrend in an uptrending market. Cross that red line and create space. Now, there'll be a battle going on right here. Trust me, there'll be a battle going on right over here. Okay, as it's trying to go back through. Okay, which actually is probably a good thing. Okay, because some shorts are trying to get in. All right, and that's when the bigger money, that's when the bigger money knows they got them trapped. Okay, so then what they're going to do is they're going to run it up, clean out the stops of those people trying to take that short. Then they're going to sit on this top right here, and then boom, your long is right there, and that thing's just going to take off. And I'm going to tell you something, that happens all the time. All the time. That pattern. So it's a crossover retest gone in the direction of the market trend for the predominant trend for the morning. Okay? So if it's long, you look for that on the long side. Now, and this is the only setup really you can have in the red line when you don't get a Donchian channel pullback. This is, by the way, more common than this. Okay? So, what's the caveat to this? Well, there's one caveat. Okay, and then and I've talked about this many, many times in my trading videos. That's the after 2 o'clock time frame. Sometimes can be a little earlier, like 1:30, 1:45, but it's the further you get in the day, okay, what's going to happen is, not all the time, but let's just say you have an up market, but it's not a big up market, okay? It's up, but it isn't because a bunch of people came out and had record earnings or any of that stuff. It's just your standard market manipulation day. That's what I like to call it, that 80% of the time thing, where the market picks a direction, they steal a bunch of your money, and then they bring it back to what I call equilibrium, which is like the overnight open prior to, the overnight open of the current day. So what will they do? A lot of times, well, you get later in the day, a lot of times what the market will do, and you'll recognize this, they'll run it through that red line. Later in the day, the more likely this is going to happen. And that's the crossover retest counter trend of the day. Because what they're doing is the day traders are closing out their trades. So what you have is you have price run through that red line. Man, I'm telling you, about 2:30, 3 o'clock in the afternoon, you see this thing cross over that red line and come back up into the bottom of that red line. I'm telling you, it'll drop like a hammer. It'll drop like a hammer. So what you then looking for is that crossover retest later in the day if the market's not up significantly. That's when, and then that retest and then rollover, that thing will just melt. But it has to be later in the day as trades are being closed out. Not like aggressively closed out, like at 4 o'clock in the evening. What I'm talking about is just, the sentiment is not there to keep pushing it to new highs anymore because we've gotten late in the day. So they start settling out their trades, and it's beautiful. It's beautiful. That's a great trade. That second one, which is the one later in the day after 2 o'clock, makes a beautiful, what do I call that? A beautiful swing trade. It really does. Makes a beautiful swing trade. Back towards the overnight open. I've talked about this in my videos. But anyway, so those are the two styles of trades. Really two different entries levels here, one here, that are happening in the 5-minute red line. Now what I'm going to do is I'm going to show some examples, and we're going to focus on, for example, what relatively smooth pullback means for continuation one, and then we're going to talk about continuation trades, the crossover retest trades also. Okay, so give me a second here. Okay, so first we're going to talk about the continuation trade. Now the continuation trade is has got a lot of the similar thought processes to it that the 1-minute gold line trade has. So what I mean by that is you've got a Donchian channel that has been pierced, for example, right here to the long side, or right here to the short side. Okay, so that's one of the main things that differentiates it from a crossover retest. Okay, it's one of the main things, because what we're hoping for with a Donchian channel pierce either to the long side or to the short side, depending on which direction this trade sets up in. What we are hoping for is that this, now I've talked about this a little bit in the 1-minute gold line, but what we're hoping for is that this is an indication when it breaks this top right here and it makes this relatively smooth pullback, that this from here to here is the pullback seeking support after the market movers made the sign, the old secret handshake of, well, we broke it out here, caught people chasing it as a runner, and then we brought it back and cleaned them all out. And then what we did is we went from this spot back to that high. Okay, that's what the intent of a Donchian channel pierce, either to the long side or to the short side, is supposed to be showing you. It's supposed to be showing you that we broke out into new territory within the last hour plus, and then we systematically moved it to a support / resistance area, and then we ran it back to that same spot. Okay, and we have 3 in a row right here. We have 3 in a row right here. Okay, that did exactly what I'm talking about. So, first characteristic, Donchian channel high. Yes, there's your Donchian channel. Remember, this is your 60-minute timer that's checking time backwards every 60, and seeing the high point / the low point of price. High point / the low point of price for the last 60 minutes. Okay. Now, it's a good eye catcher. Okay. It helps you recognize things. I personally don't focus on the Donchian channel as much as I then evaluate the pivots and what's going on. But this is really a great tool, because when you see this, it should be your eyes should start opening up now to the possibility of a 1-minute gold line trade depending on time, or a 5-minute red line depending on time. Okay, it should like open up your eyes to the potential. Okay, then so let me see here. So 5 minutes. So this is the pullback, and then you have your entry just like a 1-minute gold line. So what you do is you have your relative smooth pullback. You have your candle, which your first candle. Let's just take this one for example. Let's stick with this one for example. It's easier for me to see trades up instead of down. You had your candle that pierced the red line. Now I'm going to talk about something here. This red line right here, this red candle, looks like it's below the red line. This is where you get into that splitting kind of hairs thing, because two main things to remember. Okay. One is, see the direction of this red line that actually pulls when it's doing this. It takes this whole line right here. That's not a good thing to use. Anyways, let me remove this. It takes this whole line and keeps jacking the whole end of it up, because this big move here pulls that line up. So in live data, there's a high likelihood that this candle was literally sitting right on that red line. Number one. That's number one. Okay. It's not this. So I can't attest to that in live, but what I do know is that this head kept getting pulled up. Just like as this one's going down, see that head getting pulled down after the fact? But up here, it's facing that way. But then when this price kept going this way, it starts pulling the whole moving average down. Okay. Number one. Number two, this is the hardest part for people to get that I need to point out. And that is this. Let me do this. I'm going to try to do something here. What is this? The RTY? Give me a second here. God, give me a second. Let me do this. God, let me see. What day is this? Give me just a second. I'm going to pause this for just a second. So I can pull something up. Okay. This will show what I was trying to get to here. So this chart on the right is the RTY in a 5-minute candle. 5-minute candles. Each one of these candles represent 5 minutes. Chart on the right is our actual candles that we use on a 1-minute chart. Now, I've told this story before in the past. I have used, and this for those of you that only want to trade the red line and you don't mind taking bigger risks on your trades. Hey, here it is right here. I mean, here it is right here. Market's up for the day, right? Here's your crossover, space, smooth pullback, boom, gone. Here's your Donchian channel, pullback, boom, gone. And your break of your candle to your left can be your entry. Break of your candle to your left could be your entry, okay? I'm just pointing that out. But what I use is this because it allows me to get in most cases. It allows me to get in at a simpler, at a closer point, hoping that this micro movement back up will be the momentum for the candle that's building up for the 5-minute traders. So, see how this is all noisy right here? That's this. That's a good example. See how noisy this is right here? That's all of this. Now, see how clean this looks over here? If you took, high, 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 lower, high, then boom, there's your break. This is what you're looking at on a 1-minute candle. Now, this looks very nice and pretty, okay? The problem is we go back over here. If I get in off of this, then I'm getting in down here at 2006.9, for example, and my stop is at 2006.1, okay? So, 10 ticks. If I use this chart, I get in at 2007.9 and my stop is at 2006.1. Okay? So, again, it's like you got to pick your poison. You got to pick your poison. So why am I showing these two charts? Because what I want to show is two things. When I say relative smooth pullback, you got to visualize what a 5-minute candle trader is seeing. He's seeing exactly this: Donchian channel high, higher, lower high, lower high, lower high, lower high, just like a 1-minute gold line trade. You see that? Candle forms here, consolidates, boom, gone. That's what he sees. You're seeing this, so you have to visualize, does this kind of meet the idea of a relatively smooth pullback? And I know from seeing this for years that this is. But I will tell you this, I used to trade with this on my chart, on one chart, and this on another chart. It's just, I have learned over time that it's just easier to trade off the 1-minute chart. I never traded off this, by the way. I used the 1-minute candles for my entry, but I used this 5-minute chart to visualize things better, okay? But if you get used to it, you can visualize it on here just as well, if not better, and you don't have to occupy a whole nother chart just to see what this is telling you. You got to remember, this red line right here is not a 1-minute moving average that traders are using. It is a 5-minute moving average. I'm just using it, and I have created in my world the concept of being able to get in with less risk, but you got to see through things that you're not seeing on this chart that you could see on this one. Okay. And this is really not even a bad example. I mean, some of these, the examples can be really daunting, meaning, by the way, the Donchian channel settings are not corrected on this 5 minute. So it's on 60 periods, which 60 periods. So this would be your roll down, boom. Now your entry is here on a 5 minute candle, which is 2072. Whereas over here, it's 208.3. So it's 10 ticks higher, your entry here, than it is here, if you're using the 5 minutes versus the 1 minute. Okay. So that's the whole point, is to get you in on a tighter, so you've got less loss risk. This truly is my own 100% conception that I've come up with myself. That I just I try to get internal with this whole concept. I'm trying to get internal to what is going on in here in this candle, and what is going on, to predict what is going to go on in this candle by breaking it down to inside what's going on to the minute. And that's the whole point of using a 1 minute chart, but a 5 minute moving average versus a 5 minute moving average on a 5 minute chart. Okay. So and by the way, obviously over here, is this a smooth pullback? Yeah, it is. Let me see if it is over here, how smooth it is. I don't remember. Let's look. Okay. So see how it's got a bump right here? You see any bump here? See again. So you gotta get yourself into kind of seeing what is relatively smooth. That's why I use the word relatively smooth on a remember, the Donchian channel here is not set right. So the Donchian channel would be pierced here just like it is here. So on this, you've got that smooth pullback. You see it right there. I mean, if this was a 1 minute gold line trade on a 1 minute candle with a 1 minute chart and all that kind of stuff, and it was in the right time frame and everything for a 1 minute trade, bam, you'd be all over that like white on rice. But if this is your 1 minute gold line trade, you're not. Because now you're trading a 1 minute moving average with 1 minute candles over here, and you do not have a smooth pullback. Okay? So, anyway, so I bring this up so you can kind of see what I'm trying to tell you, that this doesn't actually show you, but this does. Okay? So, also, and most importantly, the other part is, do you see any point in here? Do you see any point in this right here where a 5 minute trader would think that a full candle open and close below that red line? Do you see any point in there where they would think that? No. So you're sitting literally on it right here. I still say the head came up is probably in there. But anyways, I could beat a dead horse for hours on this. But here's another thing. Because of this is what you're trying to get into, this whole movement with the bigger money, but you're doing it from here. That's why you got to give the damn thing wiggle room. You got to give it room to kind of massage itself. It's not going to move. 9 times out of 10, it is not going to move like a 1 minute gold line trade. Okay? It's just not going to do it. It's going to meander a little bit as the candles are forming, as this 5 minute candle is forming and all that kind of stuff. And then the next one's kind of forming and it's rolling up, and then it goes. Okay? So you have to be more patient with this trade. It's to me, it's a more difficult trade to take, but it's a more profitable trade in general. It should be a more profitable trade because it should have bigger targets than the 1 minute gold line, because you're coming off of a longer term moving average, which should have more push in the market than a shorter term moving average like a 1 minute gold line. Okay? Because there's more money behind it, bigger push, bigger conviction of direction. Okay? So, I'm sorry, I could go on and on and on about this, but so I want you to see this so you understand when I'm talking about this, what I mean by relatively smooth pullback. And you can't really get hung up on when you got this going on right here. When you got this going on right here in such a direct movement into that red line, and you're sitting there right on that red line, man, I'm telling you, you need to start looking. You need to start looking, because this is what the 5 minute trader is actually seeing. And you're moving, and this moving average is screaming to the north side. That's another thing. It's all part of that. I talk about only taking trades when the market's moving north and south. There really is not much more north and south than this. I mean, there really is not much north and south than this. I mean, can you see more north and south than that? Honestly? So, anyway, now, again, it's a Donchian channel high or low. Okay? Here's a Donchian channel high, right? You got to keep going to the latest high. Here's the latest high. Here's the pullback. Okay? Let's just follow this for a second. I want to get to my point. Now, here we are at the red line. Does that look like a relatively smooth pullback to you? I mean, it doesn't to me. I mean, it literally doesn't look anything like this. Okay? Let's just see what it looks like on the 5 minute candle. Because again, I actually do not know. Okay? We're going to glance now together because I really don't know. So we're going from the highest Donchian. Okay, there it is. There it is again. Okay. Okay. Huh. This thing may actually end up looking smooth in general. All right. What do we got here? Come on. I'm trying to move this without looking at it all. Oh, see that? Yeah, there ain't no smooth now. Even if you could kind of say, yeah, that kind of looks smooth, it's all gone right there. Okay, it should. I think it should hit the red line now. Maybe. Yep, it did. Okay, it hit the red line next. Okay, there's no smooth here. Okay, you broke that whole pattern. Anyways, this is ugly. I don't need this to know that I don't want to take this. Okay, I don't need this on my chart. I don't need this taking up a whole chart for me to know that I don't want to take this. And I don't need this on my chart, on a chart either, to recognize that this is a relatively smooth pullback also. My guess is this probably got hung up. This is my guess. I don't have it on the chart right now because I'm trying to keep it clean. My guess is this is where the 9 EMA came screaming down. Probably right into here. And price got caught up in that, as it will do so often. But it's not the time for a 9 EMA trade. It's not. I mean, it's just not. And then it fought its way through, and then bam. I mean, once it fought its way through the gold line, the 1 minute gold line here, which I'm going to assume is literally right here. it just screamed right to that red line, and then wham, down it went. And where did the red line go again? So if you had, like, let's just talk since we're looking at these charts. If this was a 1 minute gold line trade and it's the right time frame and all that kind of stuff to take it, you're probably looking for about 40 ticks. That would be what I would be looking for. So this would go from 2065 to 2002. Okay, so where's that? That would be 40 ticks. Right there. Okay, right to there. That's pretty good. That's a pretty hefty move. Now this is pre-market, so I'm just saying in general. That's kind of what I'd be looking for in a 1 minute gold line, and then I'd be following the candles as it's piercing and all that kind of stuff, hoping I get there. Blah blah blah. The entry is 2008.3, and we should be looking at least for it to go here, which is 40 ticks. It should at least go here. Okay. And we already know it did. I showed it. But so rules, Donchian channel high low right here. That's your Donchian channel. Go to the lowest, most recent candle and then read yourself back. From that point, relatively smooth pullback. Yes. Pierce candle in the trade direction. A piercing candle in the direction of the trade. Yes. And then enter, the break of that candle, which is right there. Bam. You just keep following, sell stop, following your sell stop, and then bam, down it goes. So just like a 1 minute gold line in that situation. And then what I do once I'm in, if it's not too big, this is me personally, if it's not too big from here to here, I put my stop right above that entry candle. That's just how I am. I can always, if it takes me in, then runs right up and knocks me out. Because remember, this is a 5 minute red line. This is not a 1 minute gold line. So if it takes me in and then immediately goes up and knocks me out, I don't walk away from the trade. I'll put another order here, drag it up, and look for the break of this candle. As long as it's not far down, I'll just take that break again. Okay? Because all they're doing is catching you here and then catching you there. And if it does work, they're just going to roll it back over again. I'm just telling you, this is like, but I'm not going to let it run through that top and just keep on going while I'm holding my stop way the hell up here or some crazy stuff like that. All right. Let's see here. Then, of course, we have a Donchian channel low here. Relatively smooth pullback. Don't know yet. Oh, no, absolutely not. No relatively smooth pullback. Let's watch this stuff over here. So again, we talked about how our entry is way down on this candle versus this candle because we're trying to get in the internals of that 5 minute candle. We're trying to trade inside that 5 minute candle by breaking it down into 1 minute increments. Okay. So the 5 minute candle is all the way down here and then down price goes. Isn't that beautiful? It does look more beautiful, I will admit, in the 5 minute candles. The problem is, it's tough. Because there's a lot of wiggle room you got to give it. So let's see here. Now this is this pattern right here. Let's just kind of see if it gets wacky here. I can't really tell now. Yeah, I can't. I don't know. Once this broke down though, we had to go to a new Donchian low, which should be right here. Yeah, here's our Donchian low. Let's see if we get a smooth pullback. Nope, here's our new Donchian low. See if we get a smooth pullback. And we do. Holy cow. Nice one. Nice one. Beautiful. Entries right there. You break this. Now, let's talk about this just as a side note. See this candle right here? This is the one that broke through the top. See how it broke through the top? Not this one. But this one then, by default, this one becomes your entry candle because it's the break of the candle to the left. And so your entry, once this one, if this one, let's talk about this. If this one goes up and then down, if it goes down, which it didn't because this is green. So the candle literally went from there and then straight down. But if the candle goes down and then up into here, then this becomes your entry candle. I don't know if I'm making sense to people, but anyways. Does this trade work? Yeah, it does. Okay. Just meandered. See, again, you're in the internals. Let's look at it over here and see what it looks like. Red, green. Oh boy. Yeah, see? All right. This ended up now here's the deal with this one. Here's the interesting part. This ended up being the candle that broke on a 5-minute red line, on a 5-minute candle. This actually, because this never broke this candle here. See, so those are the little things you can kind of see with this right here that you can't see here. But this candle here never broke the bottom of this candle. Not that I would ever take that trade because I'm so far down from the red line. I mean, a lot of wiggle room there. But this one formed. And then it broke. And see how big those red candles are? And so that's kind of where I say with the red line, you've got to be willing to let it meander. Because you're trading on the internals of what these traders are doing. Okay? But you're doing it so that you're in at 206.3 versus 205.3 in the case of this. And you saw some of the numbers here were even bigger than even here. And your stop is not way the hell up 20 more ticks. You know, you get in 10 ticks later and your stop's 10 ticks larger in just these simple examples. And this is all pre-market garbage. In the open market, oh my God, it can be a lot more than 20 ticks. The gap that you're doing. Okay. So anyway, so that is your I call it continuation trade because it's just like the 1-minute gold line, except there isn't really a direction maker because the market is directed by the red line itself. Remember, the 1-minute gold line is contingent on where the 5-minute red line is. The 1-minute gold line, if you're taking longs, the 1-minute gold line needs to be north of the 5-minute red line. If you're taking shorts, the 1-minute gold line needs to be south of the 5-minute red line because this is the direction guider. This is the one that's pushing the market direction. Okay, so let me pull up some. I'm going to pause this and then pull up some examples of crossover retests. And then we'll be done with this section, hopefully. Okay, next part I want to talk about is the crossover retest, all right, of the red line. And I want to talk to you about what I'm perceiving happening and therefore what I'm looking for those to be high probability trades or not. Okay, so there's two types of crossover retests. Okay, there's the type of crossover retest that happens between say 10:30 in the morning, equity market stuff here, and 1:30, maybe 2 in the afternoon. Okay, so what that is, okay, you have to understand. So this is what I'm trying to get across when I say this. Is you must understand what I'm really trying to do is I'm trying to capture um, the resuming of the direction. So let's just say, for example, the market's down all morning, and then it starts blending its way back up. Okay, right? Okay, but at the same time, you know, your 5-minute red line was following price down here. Okay, and then it was doing this and starts curving back up. Okay, because it's a moving average, but it's not the only moving average that traders are using. Okay, it's just the one that I use along with the 1-minute gold line, along with the lines, to try to find a sufficient number of opportunities to get, decent trades. So, for example, if the market's down 300 points, okay, 50% retracement, if it did it from the moment the market opened to say noon, I'm just saying it dropped 300 points. Remember, on a Fibonacci trader, a 50% retracement is 150 points back. And then it might gain some energy to then extend it. And for Fibonacci traders, that means that 150 entry spot, they intend to drive it from 150 points down through the 300, and then it becomes a Fibonacci extension. That 300 may be 350, 400 points total from overall in the market, okay, before they, close out position, whatnot. My point of that is that's just one situation that may be going on in the real world. There may be daily pivots that the big market traders are trading off of. There could be a lot of things. But what that means is, and that all has to take place predominantly in, early in the day. The later in the day, the less interested they get. Okay. That's why I say 1 o'clock, 1:30, maybe 2, but really maybe 1:30 at the most. That this situation may occur that I'm about to show you here. I shouldn't say may occur, it happens all the time, what I'm about to show you. So price meanders its way back up and breaks through that 5-minute red line, okay? Because it's seeking some other place to pivot from, i.e. fibs, Fibonacci's, i.e. prior day low, okay? That may be sitting right here. Or overnight open that may be sitting right there, or whatever. But it's seeking something to then have the sellers jump right back in and drive it back down, okay? So what we're looking for is whatever that thing is here, we don't know what it is. Don't know, don't care. Okay, that's another thing. I don't care what it is. I'm not trying to figure it out. That's not what this is about. What I'm trying to do is find opportunities for me to make money. I don't give a rat's ass why it went up somewhere else. Don't care. Okay? If I knew that magic spot, I would tell you. But I don't know that magic spot. And that magic spot changes all the time. So it's not worth trying to figure it out today. Okay? Instead, what is worth figuring out today is how do we possibly capitalize on this? And that is when price does this and comes back down below our preferred moving average, the 21 SMA, i.e. the 5-minute red line, okay, in the direction of the market, because us, using this strategy, are assuming they found their spot that they're going to reverse from somewhere north of us, whatever that may be. Now, granted, we may actually see it clear as the nose on our face on our own charts because it may have been the overnight open. It may have been the prior day low. It may have been the prior day high, but it may not have. And you have and you have a strategy on how to trade those in case that is what it is, okay? But we're not going to figure out all the possibilities. By the way, you don't want to become a fib trader, but that's a different story. So, this moves down, and what we're looking for, okay, is we're looking for price to break back through that red line. Okay, break back through that red line, create some space to the left, pierce it from the bottom in this case, and then get rejected where the traders that are trading the exact same line we are, they just add to the direction that these people are now moving it, which is somewhere down that way. Okay? So that's why it doesn't need, and this is and some of this you might start putting the pieces together to understand where I came up with this stuff. Because since something already happened up here from the prior day, from the low or whatever that the market, the direction the market had been driven, we don't need to worry about Donchian channels being pierced and all that kind of stuff because the market's already made that determination. Now we're going back down. Okay? The Donchian channel highs and the Donchian channel lows for the continuation is because we're seeking a direction, not having a bias of direction. Okay? Now we have a bias. All right? We have a bias because the market has been down all morning, we'll say. They found their rotation spot. They've rotated it back inside our red line. And then they ran it back up into our red line, broke a candle, and boom, down we go. Okay? That is one that is one half. That is one half of the crossover trade. The second half, and you don't really need to learn this one if you don't want to, because it is a little more complicated. But I'm going to tell it to you now since we're sitting here, the second half, and then I'm going to show you examples. The second half is that after 2 o'clock type stuff, okay? And I have a lot of subscribers that have done this after 2 o'clock trade and love it. But you got to be patient and you got to understand it's just not going to happen every day. Well, just like none of these are going to happen necessarily every day. But what that is let's just say that let's just say your overnight open is right here. Okay? And your market is, let's just stick with down. Let's just say the market's down. Okay, so we're going to do the same kind of thing. So the market is down. It's been down all morning, but then it started doing this stuff where it's just kind of flattening out. It's not really, there's no real conviction for it to be down. It just kind of meanders sideways, meaning, and it didn't go a long ways. So like, in gold, well, let's just say in the RTY, it's down like maybe 1% or something, but it's not huge. This is not one of those days that, all the tariff talk is screaming on TV and everybody's selling. It's not one of those Jim Cramer moments or buy moments. It's one of those things that I talk about a lot. 80% of trade days are consolidation days. Just means the market goes up, market goes down, and then the market just kind of meanders its way back to equilibrium. And what I mean by that is The only movement really is because there's manipulators. It's not because news or anything like that changed anybody's opinion about IBM or Intel or Pratt and Whitney or anything. Nobody changed their opinion at all that day. There's not news being announced about P&Ls and all that kind of stuff. Okay, it's just a day. It's just a trading day. And so what happens a lot of times is price will pick a direction. It's either up or it's down. Okay, it's one or the other, but it's not significantly up and it's not significantly down. And then what will happen is you get past like 2 o'clock, 1:30 at the earliest, and then 2 o'clock to 2:30, somewhere in that time frame. What will happen is this, and it's a great opportunity. And I'll show you some examples, but what'll happen is price, I call it traders closing out their position. The market has no commitment, traders start closing out their position. If all the day traders close out their positions, price goes back to equilibrium because the real traders, the ones that are actually saying, I'm committed to Intel for the next year, not for the next 3 hours. Those people didn't take any trades that day. But the one that says, I'm committed to Intel for the next 3 hours, well, he's closing out his position. Okay, and when they're closing out their position, what happens is, here's our red line. Our red line goes down, and then it starts to flatten out. Because price no longer is really moving down, and it's no longer really moving up or whatever. Okay, it's just so price starts flattening out, and then we get to that magic time frame of about 2 o'clock Eastern Standard Time, 2 p.m. And what you got to look for is this. Sometimes it'll run like crazy, and sometimes not as much. But this is what it'll do a lot of times. Not all the time, but a lot of times. And if you're like me, you got RTY, you got NQ, you got GC, you got CL. I mean, you could have ES or the YM or any of those sitting up on your charts, and you can see one of these, as long as the market doesn't have a great movement that day, one of them is going to end up doing something like this. And that is crossing that 5-minute red line, rotating and sitting on top. Now this is counter trend. Now we're after 2 o'clock, counter trend. Okay, can be as early as 1:30. Again, depends on the market volatility and whatnot. The less volatile, the earlier in the day it'll probably happen. Okay, the more volatile, probably the later in the day this is going to happen. Okay, it's going to come, sit on top of that, and then it's going to do this. Let's do price. Price is black on this chart. Sorry. It'll do this. And it'll just kind of start walking its way up with that red line. And then what'll happen as time starts closing out, meaning you start heading towards 3 o'clock, this thing will start jumping. And then it'll start jumping again. And that's where it goes to. It goes back to your overnight open. So that kind of leads me just on a side topic here. I talk about this a lot in my normal trading videos. If I see price, like at noon, go back to the overnight open, I literally stop trading it because we're already at equilibrium. And if we're at noon and NQ is sitting at equilibrium, I'm not talking about crossing it. If it crosses it and heads the other direction, that's different. But if it comes back to it, I'm done trading because all the manipulation that the market is supposed to have to do all this stuff throughout the day, it's gone. They've lost interest. They're not there. They've closed out. We're at equilibrium. All you're going to get now is just stupid herky jerky shit all day. That'll steal your money blind. Okay. So if I see price go back to the overnight open, and it's like midday, no, I don't want to hear about it, because I already know what's happened. All these people that make all this stuff happen, and all the people that make this stuff happen, they're already done. And you just need to sit on your hands. Well, you need to shut your charts off so you don't even get itchy to buy something or sell something. But anyway, so this is the second half of the crossover retest. Now, there's a pretty good likelihood, just so you'll know, that this trade, if it's a good one, I mean, if the market really did what I just drew right there, there's a good chance that when it does this part right here, that it is going to create a Donchian high, okay? Because price hasn't been up in that area for an hour. But it doesn't always work that way. Sometimes this 5 minute moving 5 minute red line, this 5 minute red line will come down at such a steep angle that price has been here, because what they've done, what the market has done down in here is it's run up and down multiple times before the red line got there. Then the red line steeps down below it, and you don't get that Donchian high. So it's not as simple as me saying when it crosses over and it creates a Donchian high and then pulls back to your red line, you can take that trade just like a regular continuation trade. Doesn't always work that way, okay? Because of what I just said. It doesn't, you don't know the extent of how much it's going to pull up and pull back. But the mere fact that price finally crossed over after 2 o'clock, in this case, north of that red line, created space to your left, and then sat on that line, is a pretty good chance it's going to rotate its way back up to that, back to your overnight open or somewhere in that range. It is an indication that the traders that moved this from here to here are going to be getting out. So they're going to move it from here back that way, at least. Okay? Because it's the sentiment. The sentiment was a sell, 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 sell. Well, those that sell that are just day traders, as the day goes on, their sentiment is going to be to buy their way back out of their positions. Okay? So let me show you some examples of this. I got one. I took one. I don't even remember what day it is. The first example I'm going to show is one that I took. Because I didn't do a good job managing it, and I didn't lose any money, but I should have made hundreds of dollars. I should have made hundreds of dollars. Anyways, hold on. Okay, so what we're looking for first is, since we've already done the 1 minute gold line, the continuations, we're looking for the crossover, retest, direction trade, blah, blah, blah. So the first thing to know is, what's the direction of the market? Well, here's the overnight open in RTY. So it's north of us. So that's where the market opened, and also here's where the market closed from the day before. So we're down. This is the RTY. We're down. Okay? So now we know what direction the market's going. We get to price crossed over, created some point of resistance. Don't know what it is. I have no idea. May have been a 50% retracement of the down for the day, I don't know. What I do know is that price came back down, crossed over, created space, went up into my 5-minute red line, and then broke down. Now, again, here's the thing to understand. The two things on this one. One is this is noon. This is 12:30 or whatever. But two is that you've got to be patient. I wasn't. I got shook out right here. I'm an idiot. So let's not get into that. When this thing blew down here, I put my stop at even. It reached back up in a desperate attempt to clean out stops. Whose stop was that? That was mine. What did the market do after that? Exactly what it was supposed to do. It continued its trend back towards the low of the day. Okay? So that is the direction. We are down. We are looking for price. Now, see, price came through here and then rolled up, but see, it never gave you an entry. Reached up for something, and price came down here and sat right in that red line, and then down it went. Okay? So this is the RTY. I should have been a lot more patient. I know I'm an idiot. I get that. I make mistakes trading. Trust me. I can see a chart much better than I can trade a chart. That is a fact about me. My struggles is between my ears. It's not seeing patterns. But anyway, so there you go on that. So let's just for example, I got another one sitting right here. I'm going to do a couple of these, and then I'm going to seek those after 2 o'clock ones. Okay. So hold on here. So here's another one right here. I just grabbed quickly in gold, just to give you again an example. So again, here we are. Here's the prior day close in gold. Here's the overnight open in gold. Okay. Price. This is what time? 10:20. Okay, 10:20. Which, so to kind of put it in perspective for you as a trader, 10:20 in gold is really kind of like 11:20 in equities, because it starts an hour earlier than equities, and it really goes dormant earlier than equities. So kind of shift in your mind an hour, okay? Not that it matters. But this is 10:20. Remember, I talk about I'm not playing. Okay, key. I'm not looking at the 5-minute red line, between the open and 10:30, because there's just too much volatility in equities. But in gold, it's a different story. Now it's not really 10:20, it's really 11:20. And as long as there's no news impacting gold, 10 o'clock news or anything like that, then then a 5-minute red line trade is definitely an option. So you cross back over in the direction of the market, pierced your red line, boom. And so again, why do I bring, and it goes back to your most recent low, which is right here. So, why do I bring this one up, for example, as an example? Well, because again, one of the main things that these trades are, that we're trying to do is we're trying to find where a rotation is going to be, in the direction of where we're trying to go. Now that candle right here from this point down, that's pretty much a confirmation that you got the rotation. You know what I mean? Because again, this is 10:20, 10:30, so it's not noon. Now, if you're taking this same trade and it's noon, it's going to be slower. It's probably still going to work, but it's going to be slower. Okay? So, that is an example. We're down, price ran up, reached some pivot place that I don't know about, don't care, don't want to know, unless it's one of my trade areas, like here. rotated down, got inside that red line, created space to my left, and then we continued. Okay. I mean, the reality of it is the damn thing did it again over here. It rotated up. I'm looking at it now. Created space right here. Here's your red line. Boom, down it goes again. It actually did it again right here. Now, it's also running off the prior day low, but this is it right there. Did it go any further, or did it just sit? Yeah, it just sat. The thing, well, did it sit? Oh my God, did it do it again? Well, actually, no, it didn't create a Donchian here. But that red line held again. That's pretty, yeah, holy cow. Jesus. That red line is fierce. It will hold a direction. I don't like to just trade off of it in that direction because I don't have the patience or the ability to handle the anxiety for this thing to meander around and then decide to go down here. But anyways, all right. So now I'm gonna look for some rotation trades that happen after, say, 2:00 in the equity markets. I don't know if there were any recently, because the market really has been kind of, herky jerky because of all the trade talk and stuff like that. But let me see if I can find some prime examples, and then I'll be done with the 5-minute red line. Again, it's an acquired taste trading the 5-minute red line, and if you ultimately start figuring out that acquired taste of that 5-minute red line, you may like it because, again, its intent is to create bigger winners than even the 1-minute gold line. And its intent is to be able to be traded in a much longer time frame. That 1-minute gold line, in the equity markets, you're looking at it like 9:45 to say 10:30, and then you're done. That's it. Until you become more skilled at trading and can recognize violent moves and then violent moves where you can trade the 1-minute gold line when it's not, that peak time, until you get more consistent with your trading profits and stuff like that. I wouldn't be doing that. So my point is I'm not only trading the 1-minute gold line between 9:45 and 10:30. If I'm seeing violent price action, which this is violent price action. Now, granted, this wasn't a smooth pullback, but I'm just using this as an example. This is violent price action, even though it's 11:30, and it does that. I'll take a stab at it. I'll take a stab at 1-minute gold lines outside of that time zone I'm talking about. I give that time zone because you learning this strategy probably need to focus on the highest probability times until you recognize that this violence is what's more important, not the time. Okay? Okay. So, this is the NQ. And this is a day where the NQ is like let's see here. Where's the prior day close? It's got to be on top of that. Yeah, it's got to be on top of this. Yeah, they got to be this one and the same. That would be my guess. Let me see if I can figure that out. Or maybe I don't have that data on this. Where's the close? Where is the close? Hold on here. Oh, I don't have that data in here. Okay. All right. But anyways, so the close is probably somewhere up here. I don't have that data on this. Anyways, So what you got, again, you notice how I winced and I said, yeah, you're probably looking like 1:30, 2 o'clock. Well, here's an example of 1:30, 2 o'clock. You have the market's not down much. This is the NQ. This is not down much for the NQ. This is actually not down much at all for the NQ. Okay, or up much for the NQ. But what you had is, 1 o'clock, 1:30. You got the steps. The steps are starting to change. The direction of the steps are changing. So let me blow this up and show you what I mean. So here you are. You got your, the market ran. You had your open. You had your open, and it did all its crazy stuff that it normally does, and then it made a determination, after 9:55 or so, that it was going to be a down day. Now this is a perfect example of just the market being manipulated, and there's really not this is a perfect example, now that I think about it, that the market's just being manipulated for the day. This is a perfect example, because we're up here we're up here when the market opens, and then we're down here when the market, an hour into it. It just crossed over anyways. But my point is that this movement and these multiple thrusts down keep losing energy. Does everybody see the energy being lost? You had your big push down, up, big push down, up, big push down, up, big push down, up. It was an attempt to get out of this right here that failed. Rolled down, sat in here, rolled down. By the way, this is that cross. By the way, this is that crossover prior to, 1:30, 2 o'clock that I talk about. This is that crossover retest in the direction, which then proceeded to go to, back to this low here. Then it rotated up. Now you're getting to where things are getting dicey, because it's about 1:30. This is 1:30 right in here, Eastern Standard Time. And you had this break, this roll up, and then you had this push down. So here we have indecision. You have the sellers trying to get more out of what they had, and you got the people that have short positions being like, I'm not as committed anymore, I'm taking my profit. And you start getting this movement where you're going north and south. These are north and south, but your steps are changing. So you broke this top right here, and you came down, and this top is higher than this top. This is a little mini micro. I don't even consider that. Look at the length of this. And then you ran up through it, broke both of these pivots to the left, created this space north of the red line after 1:30 by about 15 minutes or so, and then wham, and you did that slow melt all the way back to the overnight open. Get the hell out of here. That's the trade I'm talking about. That's the setup I'm talking about. That's the time frame I'm talking about. Okay? And as this thing gets further along, the moves become bigger, because those that are holding their positions for this short to ever come back to life again, they start losing confidence and they start rolling out faster. And then boom, there you are. So this is a perfect example. It's a tough trade to recognize unless you've seen it. And I'm not suggesting that this is how you come out of the gate trying to do this stuff, but be aware of it. be aware that it happens, because someday you just might have one set up in front of you and you go, oh my God. And then you know what they're trying to do. Okay. And so at that point, you just start following these bigger pivots with your stops, knowing that this is your target. See, boom, because now the steps are going to continue to go north. Or in the case of a short, your steps are going to continue to go south. And these are your steps. These are your steps. These are your steps. These are your steps. And then bam, there you are. And again, I don't get into all the BS about it, but this is a much bigger move. So you're at 320, and this is 520. So that's 200 points. 200 points on the NQ is a lot of money. So it's $4,000. This rotation, crossover retest after the 130 mark back to the overnight open is $4,000 with one contract. So that's an example of the crossover retest rotation. That is the second type of crossover, where you're counter trend trading the direction of the market, not continuation trading like this one here in the direction of the market. Okay. Once you get past this 130 time frame, I wouldn't be doing these anymore, because that's not likely going to be the direction unless we are significantly down. Then what you'll find so many times is price will come back, sit inside this red line, and it'll just, as the market heads towards the closing, it just keeps creating new and new and new lows. If you ever paid attention to the market, you will notice that if the market has a very large down day, it has a tendency to close down from the down. But if it's not, it has a tendency to cycle it. If it's not a big down day and not a big up day, it has a tendency to cycle its way the other direction. It's a non-moving day. Okay? So there's my examples there. Whew! Man, this 5-minute red line segment of this training video wore me out. Anyways,